What's up, party people? My name is Sunny Ray. This is the Sunny Ray Show. Oh my goodness. I am really excited about my next guest. This will be what? I guess interview number 2 for the day. I've got Seth Levine joining me in a minute. He's the co-founder of Foundry, the Boulder VC firm that grew to nearly $4 billion across 8 funds and 200 plus companies, including Fitbit, Zynga, SendGrid. Then announced from day one logic, the $500 million 2022 fund is the last. He's a best-selling author of The New Builders and Capital Evolution. He's the co-founder and CSO of Goodbread, lending to small businesses on character instead of credit scores. So I'm going to bring on Seth. Hey, Seth, how's it going?
Hey, Sonny, thanks for having me.
Yeah, I'm really excited to have you on here. So where in the world are you? Somewhere in California?
No, I am. Well, I live in Colorado, but I'm actually on the East Coast
Colorado.
in the summer, so I'm happy to be in slightly cooler weather right now. I'm on vacation.
Awesome.
Yeah.
Awesome. So, do you want to kick us off with, I guess, I mean, it's probably hard to encapsulate the story of Foundry in a few words, but, maybe we'll keep it under a little bit and then we'll go deeper into it later on in the interview. But would love for our guests to just know what Foundry is and how
Sure.
you guys have built such an amazing entity.
I mean, if there's a phrase that I think encapsulates Foundry, it's radical intention, right? We started Foundry in a very deliberate way with a deliberate process. We actually, it's interesting. We still work with the same like executive coach, organizational coach that we've worked with since before we even started Foundry, before we even had a name. We had come together and we were working with this woman, Nancy Ralston, to help us think about how we'd build a firm, right? We're talking now over 20 years ago. We came together, well, right about 20 years ago, actually. It was the summer of 2006 when my now partners, Ryan McIntyre and Jason Mendelson, moved to Colorado from the Bay Area where they were living. And we started working on what became Foundry. The first fund was raised in 2007, but we started working on it that summer of 2006. So right exactly, sorry, I said 20 years ago, 30 years ago. No, 20 years ago. Gosh, I'm in the wrong decade. I started venture almost 30 years ago. And so we were very deliberate about how we wanted to pursue what we were doing. And that included things like how we'd think about syndication, right? We've always been what we call syndication agnostic. We're happy to have co-investors, but we don't have to have them. We also believe very deeply in this idea of, strong convictions loosely held. We believe in every deal is a firm deal, right? So we don't have individual track records. We have a firm track record that we're building. So we believe the thematic investing, which was not even a thing back then. We sort of pioneered that concept, right? It wasn't investing in sectors or trends or things like that. They were broad themes. We actually back in the day we used to host conferences around our themes, which were really interesting. So we did a number of those across the years, in particular around our glue theme, connective technologies, but also human computer interaction, a couple of other things. And so that was kind of how we built the firm. Now, one of the things that we decided was that we would build the firm and it would be just really the four of us effectively, no analysts, no associates. We do our own work. And then when we were done, we're done. We did end up bringing a few new folks on. My partner, Jason, retired. We started a fund of funds practice. Lyndall Ekman from UTIMCO came over to start that with us. And then my now partners, Jacqueline and Moody, also joined. So, a few slight changes from that overall plan, but the plan itself was still the plan. And so in 2022, we raised $500 million. It was our last, turned out to be our last fund, our most recent fund as well. And in 2023, we announced to the world, like, okay, this will be it, which was fine. Like, it wasn't a big, particularly, like an announcement to great fanfare, right? I think people thought it was interesting. Why is Foundry, closing up shop? And we said, well, that was what we always intended to do. We announced it then deliberately. I mean, just selfishly, like, we didn't want to announce it like this year and have a bunch of people be like, well, they couldn't raise another fund, so I guess they decided to call it quits. We wanted to be really clear right after we had raised a pool of capital, a healthy pool of capital there, $500 million, that that was it for us. And I'm really proud of that decision, right? And I think that you know there's nothing wrong with building a generational firm, and there are some really solid generational firms. I think there's a lot of firms that are planning on passing the torch, but are going to struggle with it, right? And with venture is actually not that old an industry, particularly in this current incarnation. And so I think that there are a bunch of firms that think they're going to transition, that are going to really struggle with that. Um, but for us, we felt like we'd had a great run, and each of us is going to go do something else. It may or may not be formal, right? I don't expect Brad Feld, my partner, to do something particularly formal in his future. But Lyndall, for example, has already gone out and raised a fund of funds. I'm working on another fund as well. So each of us is going to kind of do our own thing that's post Foundry. But it felt like Foundry had had a great run, and I mean, it was funny. We always said we'd do this for 20 years and then we'd be done. And 20 years in, feels like it's the right time. Now, obviously, we've got a lot more work to do, right? We're still actually in our investment period for this last fund. So we, potentially have a few new deals to do, and then lots and lots of work with our portfolio. So, the venture industry is a funny one. When you stop, it's not like you get the banker's box and you carry it out and you're done. You sort of have to transition out of a fund over time, and obviously we take our duties to our investors very seriously, and so really feel like there's plenty more work to do, but doing it in a sort of different way than we did when we were constantly raising new funds and making new investments, etc.
That's so interesting. So take us back before any of this, Seth. Where did you grow up, and what kind of kid were you before business entered the picture?
Yeah, well, I'm sure I was a pain in the ass. I imagine if you ask my parents, but I grew up actually not that far from where I am now. I was just outside of Boston, and I mean, I grew up in a very kind of academic family. My dad was a professor when I was born. My mom was a ninth grade teacher. Um, Ultimately, my dad moved into the computer business. He was a physicist, so he had a lot of math science background. And it was, we were very solidly middle class when he was a professor, even though he was highly credentialed. Both my parents have PhDs from Harvard, but I remember him counting bus tokens and things like that, or bus fares, back when I was a little kid. And I just think he didn't think that was going to work for a family, and so he got a job in the burgeoning computer industry in Boston, right? What we call the 495 loop now. And it was a really interesting time to be in that business. It was great for me because I basically always had computers in the house. Now, when we're talking late 70s, early 80s, these are like terminals, right? And we would dial into the VAX system. My first modem, I remember it well. I wish I still had it. Was a 300 baud modem, 300 bits per second, not megabits, bits per second. And you actually plugged the phone into a cradle on the modem. It was amazing. And then we got a 2400 baud modem, and it was like blazing fast. And I used to chart Red Sox games, and I used to play this computer game called Adventure, and I did some programming in BASIC and stuff like that. And so that was kind of my childhood. My mom also went back to get a PhD from Harvard, and ended up being a school principal. And that kind of changed the trajectory of the two things changed the trajectory of our family. But that was the kind of stuff I was into, and I was the kid that was like selling lollipops from his backpack, and had a little bit of an entrepreneurial flair. My probably most entrepreneurial thing I did was I started a SaaS business when I was I don't know, probably 12 or 13. It was shoveling as a service. I used to grow up in the Northeast, it snows. And I used to earn some extra money by going around to my neighbors, and they give me $5 to shovel their walk or whatever it was. And one year I was like, I'm going to go out in like October, and I'm going to go and basically say, hey, for $20 a month, I will shovel as many times as it snows. And I got a bunch of people to sign up to that. I mean, obviously it's not a lot of money, but this is back, in the early 80s, early to mid 80s. And then I would like pay some friends a little bit of money when it snowed a bunch to go out and help me shovel. And it was a pretty good business. Most months I did fine. Some months, and it's only my time, right? So some months I spent a lot more time shoveling than I thought I was going to be. And so it didn't work out quite as well, but it was a great experience, like to sort of launch that business. I did it for a couple years. And I liked it because I knew exactly what my income was going to be. And, those days when you go to shovel, you kind of got to get out early, right? Because people want their walks done right away, and otherwise they go do it themselves. And what I particularly liked about this business was people knew that I was going to be there, and I think I said I'd be there by noon or something like that. So I had a few hours to go hit everything, but I wasn't feeling rushed because, like, if I don't hit that next walk, someone else is going to go do it, or the homeowner is going to go do it themselves. So, anyway, just a little glimpse into my kind of entrepreneurial history.
And then you graduated you had degrees in economics and psychology. I guess why that combination, and which one has done more work for you in your career?
Love it. Totally accidentally, right? I mean, the truth is, I came to college I went to a small liberal arts school in the Midwest called McAllister. Fantastic small school outside of, or in St. Paul, but outside of downtown St. Paul. And I loved it. It was a transformative experience for me. The people I met, the professors I worked with, all of that. But I came to be a psychology major. And I took my first econ class, maybe it was the second semester freshman year or first semester sophomore year. I liked it, took another one, liked it, took another one. And eventually I was like, well, I guess I'll get a minor in econ because I've been taking all these classes. I really like it. But really was focused on psychology. My honors thesis was in psychology, all of that. And I guess it was the second semester of my junior year. I was taking like an advanced econometrics class, and I had to, because of that, I needed to be in the computer lab that was in the econ department a lot because I was building these econometrics models, and we didn't. I had a Mac Classic in my dorm room, but that was not a program that you could run on your Mac Classic. You needed a bigger machine, and so I was in the computer lab a lot, and I knew the professors, and I would spend some time in the computer lab. Was attached to the office, and one of the people I became friendly with was the executive assistant, the secretary of the office for that department, Nancy. And we I don't know, we just shot the shit a lot. We really liked each other. And she came to me one day towards the end of the semester, and she was like, you've taken enough classes to be an econ major. You just need to take basic financial accounting. I must have already signed up for something next semester, so she already knew that I was like, yeah, I don't know. And she's like, I filled out the form. You're going to take it. You're going to be an econ major. By the way, you're going to graduate at the top of the class in econ this year, your year, if you don't mess up BFA. And I was like, all right, I guess I'll do that. So I took BFA. I remember I was not only was the only upperclassman in the class, the proctor for the class was a junior, and I was a senior taking the class. But I took accounting because that was what was required at Mac at the time to be an econ major, and so I became a double major. Now, interestingly, I'm sure that's why I got my job in banking. I actually wanted to be a psychologist, and there wasn't really, like, when you think about like Richard Thaler and sort of this behavioral economist concept, like, it was just starting to happen, but it wasn't really a thing. And I think if I had understood that, like, that was what I really wanted to do, was like this intersection between the sort of economics and the economy, but how like real people behave. And so both those things really were fascinating to me. But I had an experience where I thought I was going to get a psychology internship the summer after my junior year, and I hadn't planned on anything else because it was McAllister stack ranked their students. Someone had always gotten this internship. I was on the top of that stack. And so I was like, well, I'm definitely getting it, and maybe the second person gets it. And for whatever reason, budget cuts or whatever, no one got it that year. And I was like, I don't know what I'm going to do now. And I didn't have money or anything. And I ended up getting paid internship at an insurance company. And I made it was like $3,200. I mean, it was not a lot, but it was a 2.5-month internship. It was more money I'd ever made in my life. And I was like, I think I kind of like the business world. And then at the same time, something happened where I had gone to this lecture. Um, this was the beginning of my senior year. I'd gone to like a big lecture thing on campus, and it was a woman from Northwestern. And anyway, she was talking about welfare. What she was talking about wasn't that important relative to the story, but she had an academic perspective. There was a big dinner and 400 people in the chapel, which is where we held these big talks at Mac. And then like 3 nights later was a woman who had been on welfare and written a book about it. And I was like, well, this is perfect, right? Like, here's this academic talking about it, and here's this person like lived the real life experience. And I went to that talk, and there were like a half a dozen of us there. It happened to be in the same space, so it was like very the juxtaposition was very clear. And I was like, you know what? I want to be in this room with the people that actually lived it, even if there's only 6 of us, not in the pomp and circumstance room. And it just, something about that, something really turned me off from academia. And I shifted my focus from like applying to grad school to I'm going to go get a job somewhere. And I lucked out and got this job at Morgan Stanley in New York as an investment banker, and just kind of didn't look back from there. Right. I mean, it was an abrupt change for me because I was absolutely certain I was going to be a psychologist. But sometimes things
Actually, I was going to ask you about that chapter as well. So what did that pressure cooker teach you, and why did you eventually leave?
The main thing it taught me was like something around like everyone has potential, and I had potential, I guess is the right way to say it. Like, I was so intimidated coming into Morgan Stanley. So at all the investment banks, I assume it's still like this, they have recruiting teams for each school, and each school gets a specific number of slots for that next analyst class. So Harvard gets 10, Yale gets 9, or whatever. And then everyone else is in this bucket, this like consolation bucket. I think my year there were 8 slots for every school that wasn't a recruited school. And so you already show up being like, I basically took someone else's spot. And the other teams kind of make you feel that way because the Harvard folks want to hire another Harvard person, and the Brown people want to hire another Brown person. And I just was like, all right, I don't know that I belong here. And I was very intimidated. And then I had this experience in my training. The degree I have in economics is a very theoretical, kind of math heavy econ degree, not finance. Never took a finance course, like never. And we were in this training, and they were talking about something about discounted cash flows, but they were calling it DCF. DCF this, DCF that, here's how we do this, here's how we do that. And I understood the math part of it, but I was like, I literally don't know I don't even know what DCF stands for. And I was like, I am so screwed. Like, I am, and this is pre-internet. So it's not like I could go home and be like, what is a DCF on the computer? We had a textbook, like a finance textbook. I eventually figured it out. But I was super intimidated by that. But by the end of my first year, I was like, we're all the same, right? Like, I had a great training at McAllister. I did really well my first year because I was also a psych major, and I could like talk to people, and and that was helpful. And I ended up at kind of like the top of my class. They sort of the top section, I guess is a better way to say, of my class. And I was like, okay, this is. I thought I would not stand a sort of hold a candle to any of these folks because every school they recruit from is a school I couldn't get into when I was applying. But I realized, like, it's the experience that makes the person, and working hard and working smart, really is like the way to get ahead, right? And I mean, when you were at a bank, especially back then, like it was a lot of work. It was a lot of grind. But I kind of enjoyed the grind for what it was worth. And, I was in a 2-year analyst program. They actually offered to let me skip business school and stay at Morgan Stanley. They call it an accelerated career path. And I thought about doing that for a hot minute. What actually happened is one of the analysts in the group that worked next to mine, in the bullpen next to mine, had a heart attack at like 22, 23 years old. And I was like, maybe banking is not for me. And I wanted to move to Colorado. So I called up. I happened to do some work with a company in Colorado at Morgan, and I called up the CEO and just said, "Hey, I'd really like to move to Colorado. Can I work for you?" And he said, "Absolutely. Someone's going to call you in 5 minutes." And that was how I got my job.
Is this First World?
That would know his company before that was called ICG. It was also a telecoms company. The guy that called me back, who I didn't actually know at the time, he called me, ended up being the CEO of First World, which is how. So he and I got along really well. He was incredibly helpful and generous to me as a boss. Gave me, put me in a lot of positions I probably didn't deserve to be in. And then he eventually left to go restart First World, and I came over with him to do that, which was an incredible experience.
Yeah, actually, I was gonna ask you about that. So, you were, I think, the third employee of this restart, turning essentially like an old phone carrier into an internet company while running finance, M&A, and investor relations in your 20s. I mean,
Yeah.
what did that, crash course teach you that no VC job ever could?
I mean, kudos to this guy, Sheldon Orner, right? I mean, he was my boss at ICG. He brought me over to First World. At the time he brought me over, there was a guy running corp dev, and he says, "You're going to work for this." I think his name was Andy something or other. He's like, "You're going to work for this guy, Andy." And truly, a week later, he called me up and said, "I think you have better skills, essentially, and I trust you. I've asked him to leave. You're going to run corporate finance. And by the way, I'm not planning on hiring a CFO. We're gonna have you and a chief accounting officer, and I want you to run all of the corporate finance stuff. So all the business modeling, M&A, et cetera. And we're going to acquire a bunch of companies. And we had done a bunch of M&A at ICG, and I had run that group there. So I knew a lot. I knew how to prosecute deals, and that was kind of what got me started. And that was in 1998. We built that up, bought a bunch of companies, became this more sort of data comms business, had a bunch of data centers and some other sort of internet style assets, and took that public in the year 2000. And that was an incredible experience. And I led the IPO process, and we raised some concurrent capital from SAIC, Lucid, and Microsoft. I negotiated all those deals. I mean, it was just like heady time. Enron had been a big investor in the company, and I had negotiated some of the stuff around that, like literally sitting across the table from Jeff Skilling, right, who went to jail through the Enron stuff. And so it's just a really interesting time to be in that business, which was great. So the bubble burst, so it didn't end well, but.
And Seth, how did you first meet Brad Feld, and what convinced you to leave, operating life behind, to go work for him at SoftBank?
We eventually, at First World, which had then at that point renamed itself to Verado, they wanted to focus on basically their data center business. Not a bad idea, but that's what they wanted to do. They took the entirety of the rest of the company and put it under me. So this is, I guess I'm in my late 20s now. And that was a couple hundred people. It was a $55 million revenue business, a series of businesses. And they basically said, "Look, why don't you sell operate these, right size them." I learned a lot about operating, right? Including, like, I would spend a day a week in the accounts payable. I eventually was like, no bill gets paid in these organizations without me signing it. Because it was losing like $7 million a month at the time I took it over. And I just needed to get my hands around it. And I couldn't figure it out enough, like it was just getting too hard to figure it out. And I was just like, I just need to see literally every bill, and I'm going to ask why we're paying it and what we're spending this money on. So great lesson in sort of how to be an operator. And I ran that business for about a year, and sold it off in a series of pieces. And they made me an offer to stay. But at that point, Sheldon, who had brought me in, was gone, and I didn't really love the new management team. And I just was like, I think I want to do something else. I had some friends in venture from my Morgan Stanley days, and I was like, venture seems like fun. Obviously, the bubble was burst, right? We're talking now 2001. But I did a bunch of networking, and I didn't realize how small the venture community was in Colorado, which was not good if you're looking for a job. But I was able to get some meetings with a handful of people. And the lawyer that worked on the First World IPO, Verado IPO, was really close with Brad and introduced us. Took me 3 months to get on his calendar. And we had a meeting where I just, said, "Hey, I'm interested in venture." And I don't remember it specifically. He was, he had long hair and was kind of crazy. And he said, "Well, I think we're going to hire an associate. Um, are you interested?" And I was like, "Yeah." I mean, that was a big step back in terms of where I was in my career at the moment, but I was, I was single and I didn't have kids or anything like that. And I was like, "Well, now is the time to invest in myself. And I think I want to give this a try." So I went through their process. The funny story about this, Sonny, is I ended up being one of 2 finalists. And there were a handful of people that interviewed us, including Brad. Brad wanted to hire the other guy. And everyone else said, "No, you should hire Seth." And Brad, because he's Brad and amazing, was like, "Okay, if you guys think that, I trust you. I trust the group's judgment more than I trust my own judgment." I mean, could you imagine? I mean, I sometimes think about my life, and not just the fact that Brad's one of my best friends, and that wouldn't have happened but just everything that's happened in my life and the success and everything else. Like, if Brad had just been like, "Yeah, sorry guys, like I appreciate your input, but I'm going with this other guy." I hope that I would like to think I would have been successful doing something else, but obviously a very, very, very different trajectory and a different way of spending my time. But that's like Brad in a nutshell is like, "Yeah, okay, you guys, we put together a process. I trust the process, and if that's the judgment of the group, then we'll go with that." And obviously, it worked out well. Well, it worked out well for him too.
He said that, I have a lot of questions for you. I was gonna say, and I don't want to rush it either. And so maybe we could do. We still got another 10 minutes left, but maybe we could do like a part two as well. That way we
Yeah,
can cover
okay.
everything.
You're
But
saying I'm long-winded, and I know it.
oh no, I'm enjoying everything. So that's what I'm saying. So I was gonna ask you, how did starting in a nuclear winter? Why are your instincts as an investor in
Yeah.
like that '01 period?
What an interesting question, Sonny. Thank you for asking that. I knew what I was getting into, right? I often say it's not like the keg had run dry at the party. Like the keg had run dry, the cops had come and gone, right? Like everyone's gone. And so it was very, I mean, I knew because I started, and by the way, I started on September 7th, 2001, right? So 4 days later, September 11th happens and it gets even worse, right? And by the way, we can't travel for a while. And we were a Colorado outpost for a Bay Area fund. And so it was hard. I had done, because I had done this work of right sizing these businesses before I sold them at Verado. I had some experience doing this sort of workout stuff. And I did a bunch of that in the SoftBank portfolio. So much so that I got the nickname the Angel of Death, right? At least internally, because they would hand me the broken toys and I would sort of go in and assess whether we could right size them or whether we needed to try to sell them, or in some cases we needed to shut them down. And when I started at SoftBank, Brad was on like 30 boards. I mean, it was ridiculous, right? It was crazy. If you ask him about it, he'll tell you it was insane as well. He didn't realize how out of control it had gotten. And so yeah, I spent a lot of time sort of seeing what breaks at companies. I think it's made me a little bit cautious as an investor. It probably hasn't always served me well, right? Sometimes you just need to take the leap as an investor. And I think in some of these cases, what I learned was sort of an abundance of caution that maybe was too much. But that was my sort of foray into venture. Now I had a few years before I could do deals on my own, right? Because I worked at, it was SoftBank Venture Capital. Eventually, it changed its name to Mobius Venture Capital. But I worked there from end of 2001 until we started Foundry, sort of in 2007, right? And so I eventually got promoted to be a super junior partner, but I was not going to do my own deals there, right? So the first time I got to start to do my own deals was really in 2007, late 2007, at Foundry. And so I had some time to kind of work it all through my system.
Got it. Was there one moment when you knew venture was going to be your life's work, or did it kind of like sneak up on you?
I thought it was not. I mean, so the funny story about founding Foundry is in 2000, maybe it was 2005, Mobius went out to raise another fund. And it's probably late 2005 at this point. And I was super junior as a principal is what they called us, which is like a junior it's a partner is like overstating it. It's not even, it's like a senior analyst, a senior associate. Um, and I sat down with Brad and said, "Hey, I'm not quitting today, but I just want to let you know, I'm not going to stay." By then, I was married. We had I think 2 kids by then, and it just wasn't working, and I just didn't see a sort of a career trajectory. And so I said, "Look, I'm going to be done." And Brad was like, "Hey, actually, the fundraising isn't going very well. I don't think we're going to be able to raise this fund. I'm thinking about just doing my own thing. Would you want to do it with me?" And that's what started a conversation, eventually included Jason and Ryan, that led to founding Foundry. So I sort of tried to give up a venture, if you will, and that's what that conversation is what sort of got us starting along the path of Foundry. Now, once we started Foundry and we had some pretty good early success, it was pretty clear. I don't remember the year, Sonny, but I remember at some point, maybe it was like 2012, sort of realizing like, this will be I don't know if I'm good at this or not, but this will be my career now, right? Like, this is what I'm going to do. Like, we were 3 funds in at that point, and I was like, okay, yeah, this is what I'm doing.
And you guys started with a thesis that I assume most people thought was wrong. Build a top venture firm from Boulder, not Sand Hill Road, right? So I guess what did you guys see that they didn't?
Yeah. I mean, that was core to what we were trying to put together, right? Was this idea that you could build a great nationally focused venture firm that wasn't in, Boston or the Bay Area at the time. That was it. And we believe that Silicon Valley is a unique place, and it continues, as we've seen in the AI boom, to be a very special place. And you can build great companies anywhere. And so we believe that incredibly strongly. And by the way, that wasn't to the exclusion of the Bay Area, right? You mentioned Zynga and Fitbit, for example, two of the companies you mentioned in the intro. Both of those companies were Bay Area focused or Bay Area based, right? So it's not that we didn't do deals in Silicon Valley. It was just that we didn't think that was the only place to do deals, right? So if you look at Rover from Seattle, or Xometry in DC, or AdMeld in New York, or SendGrid in Colorado, who would also mention in your intro, like there's a long list of really good companies and exits that we've had from businesses that weren't started in the Bay Area. And so that was our belief. It took some convincing of LPs. Plenty of LPs didn't see it, and they kind of missed the boat on that. It's funny to think back on how hard it was as an emerging manager to raise funds. There was not like an emerging manager thesis, right, at all. And it was really hard. And there weren't really any successful emerging managers at that time, right? USV, Union Square existed, but hadn't done any of their breakout deals. True existed, but also hadn't done any of their breakout deals. And in fact, it took True a little time to get going. I remember doing due diligence calls for them, and LPs sort of saying like, why doesn't True have one of these big breakouts? And like, I like those guys so much, and I believe in them. And I would just say, well, they're clearly doing all the right things. They're going to absolutely get there. Spark existed, but again, also hadn't really, like, they were on fund one, and that was like the entirety of the emerging manager landscape, right? So it was really hard to convince people to take a flyer on these guys, 4 guys from Boulder. And I was, again, it's so funny now because there's plenty of GPs that are in their late 20s or early 30s. I was in my early 30s, and it just was like, people would say you're too young to be a GP. Like, you essentially, I don't know if they meant you hadn't earned it, or if they were just like, you haven't seen enough life experience to make a good investor yet. But it was really interesting back then to try to convince people to do it. Obviously, we were fortunately able to convince people, one of whom was Lyndall, who's now my partner. And that's what got Foundry going.
So across 200 plus companies and nearly 50 funds, which like single investment, like win or loss, taught you the most about how this business really works?
Gosh, it's hard to single one out. I can tell you a couple of stories. I mean, the one that always comes to mind is I co-founded a business called Trada that was trying to essentially do crowdsourced SEO SEM. And maybe it's because I co-founded it, and I felt this like visceral connection to it. It was not a successful deal. Our co-investor was Google Ventures, which was great. became very close with Rich Miner, who was one of the two founders of GV, one of the Android founders. Super interesting, incredibly smart guy. I learned a ton from working with him. Still friends with the CEO founders, Neil Robertson, and it was just incredibly frustrating. It was just a good example of like, it should have worked, but we made some deliberate and very wrong investments. We thought we needed to scale sales in a certain way before we really had the formula down, and that kind of premature scale has like really stuck with me. When we spend money at companies that I work with, I really want to understand like what makes us believe that this is a smart dollar to spend and that we'll get a return on it. So that one definitely sort of comes to mind as a lesson learned, and a hard one. AdMeld was for me my first kind of first big win of a company that I really sourced and championed. It was bought. We were investors for, I don't know, 4 or 5 years. It got bought by Google for about $500 million. Our first check into that was $500,000 in a 3 post, right? So that was kind of my first big ticket win as a VC, and that gave me the confidence that I knew what I was doing. I mean, it's such a weird business because you get feedback. So first of all, the feedback is so delayed, right? You make an investment decision, you make a bunch of other decisions along the way, and frankly, the company makes most of the decisions along the way that they may or may not either consult you or follow your views on. And then 10 years later, you find out whether it worked or not. And sometimes you're like, hey, it got bought for a lot of money, but did that work? Like, someone was excited enough to invest in it, but was it really worth that? Versus some other company that maybe grew bigger, but was somehow less exciting and exited for a third the amount. And did that not work? Right. So it's this odd feedback loop on sort of how these things cycle through. And so that's, but I like that challenge about venture, and that I think is partially what keeps me excited about staying in the game in venture.
What do you believe about venture capital today that maybe you didn't believe 10 years ago?
Hmm. I think, well, what I really believe is venture is in trouble, right? We are highly concentrated as an asset class. The returns are concentrated. The capital raised into venture funds is incredibly concentrated, right? 6 firms have something like 85% of all the funding that goes into venture. I don't think that that's good for our industry. It's great for those firms. There's several very large, almost asset management style firms in venture, many of which have done incredibly well, right? Like, and so I understand why LPs are like, look, I can write a bigger check, and I'm still producing the same sorts of returns. But venture is a really difficult discipline, right? The 75% of venture firms, sorry, the 75th percentile of venture firms don't return capital, right? And it's really only the top, I'm not even going to say top quartile, it's like the top decile returns or funds return above what I would consider to be an acceptable risk-adjusted rate. And so it's a tough business, right? It's a hard one.
Can you tell me about Good Bread? So why does a VC who managed, nearly $4 billion decide that his next act is $50,000 loans to businesses?
Yeah, it's a great question. It's a real passion of mine, right? So I wrote a book. The first book I wrote that came out in May 2001, so 5 years ago, was about the changing nature of entrepreneurship and Main Street entrepreneurship in the United States. And one of the observations is we don't do a good job of connecting capital to those funders. I call them new builders. That's the name of the book. And I had an opportunity with a partner, Noah Simons, to start a lending platform to see if we could solve that gap, right? How do you make small loans, right? Because a lot of these Main Street businesses, in part, don't qualify for larger loans, both because they don't have the financial wherewithal to qualify for a large loan, but also because they can't get a smaller loan, right? Like the banks that they go to, just because of the way the model works and the expense of underwriting, can't underwrite a $10, $15, $25,000 loan. It's got to be a $150,000 loan, and it doesn't make sense for the business, and they don't qualify for it. So what we've proved so far at Good Bread is that like 100% we can do that, we have an underwriting model that works. We have at the moment, zero loss rate. Still pretty early, so we're talking about dozens of loans, not hundreds of loans. We work primarily through other organizations, so we basically power CDFIs and sort of community business development organizations to stand up microloan funds and loan funds. They do it on the backs of our technology. We've got a module that is all around loan preparedness. We just won a $1.4 million grant from the Kauffman Foundation to do some work with them and give KC on exactly this. How do we help entrepreneurs be ready to go raise money? And so, there are 33 million small businesses in the U.S. The vast majority, 85%, are self-funded, right? They're not funded by banks. They're not funded by venture. They're not funded by any other source other than sort of friends and family, home equity lines, credit cards and things like that. And we just felt like that there is so much opportunity in the U.S. that we are leaving on the table by underfunding this segment. Not a knock on venture. Venture works great for that market segment, but it's an observation that our economy can and should be growing faster if we were able to get more money in the hands of more of these new builders. And so after complaining about it for a while on the book tour, I was like, all right, let's just start this business. And fortunately I met Noah and she had the same sort of predilection on this. And so we started it together and we're trying to prove that this works. So we've definitively proved that we can underwrite loans effectively and service them at the small level. Now we need to prove we can scale it.
That's fascinating. Hey, so I was going to say you've written that AI adoption inside startups is dramatically outpacing the enterprise. What are you seeing across the Foundry portfolio, and what does that gap mean for founders?
Yeah, I think there's a real opportunity now for smaller, nimbler companies to leverage AI more. And it makes sense, right? I mean, if you're a big platform, you have tons of customers, etc. You have a different calculus on how you can even just keep your deployment systems open and allow access to AI. When you're a smaller company, obviously you've got to be careful about this stuff, but you could just move more nimbly. And if you're moving nimbly right now, you can be moving incredibly quickly. And so we're seeing massive amounts of leverage across our companies. That doesn't necessarily mean that companies are shrinking their workforce. It means that they're growing in different places, right? More around go-to-market, for example, and they're able to get more operational efficiency out of development, product, and sort of those parts of their organization. It's just a really exciting time. And I wrote more recently about just being careful of those of us in the bubble, the AI bubble. And by bubble there, I don't mean economic bubble. I mean just sort of the encapsulation bubble, where like AI has been amazing for us, but also like recognizing some of these larger societal trends. I think we make a mistake by just dismissing people that are worried about AI. It's like, oh, they're Luddites. They don't know what they're talking about. Like, no, people are really experiencing AI in different ways, some of which are negative ways. And I want to caution us to keep our eyes wide open about those experiences, because for everyone like you and me who finds AI to be a superpower, and it's completely, I don't know how it is for you, it's completely changed my approach to work. In some respects, my feelings about work. I spend more time on the stuff that I really like to spend time on and that I think is more value added. Like, all these things are absolutely true. And it's also true that there are probably many more orders of magnitude more people in the United States and elsewhere that experience the backside of AI making decisions for them and on them, that either they don't understand or that don't really make sense. And that, I don't want us to take that for granted, right? That people have different experiences being on the front end or the back end of AI. I don't know if you've seen the same thing.
Oh, I feel like life has become a game. Like I'm always in a state of flow and delight, and all of the things that took up massive amounts of energy or brain power are now somewhat delegated to AI, and I can just do the things that I love, like talking to people.
Yeah.
He said you've backed nearly 50 emerging managers through Foundry's fund investment. Uh, Honest read, does venture consolidate into a few giants or fragment into like 1,000 smaller firms?
I mean, the history of venture says it fragments and then contracts and fragments and contracts. I don't want it to contract because I don't, as I said earlier, I don't think it's healthy for the industry to have a huge portion of capital controlled by a very small number of firms in venture. Um, so my hope is that we'll continue to find ways to fund emerging managers. That said, I worry about a lot. I think we're in a contraction phase. I think there are a lot of funds. In particular, there were a lot of funds that were started sort of the 2020, 2021 timeframes. Those are bad vintages. And I think they're going to struggle to raise, the second fund. So I think that there'll be, and by the way, I saw this in kind of the 2001 to 2006 timeframe was another contraction period. So I think we'll go through a period of contraction. My hope is that we'll have some expansion beyond that. But I think that's just the nature of the industry. We kind of inchworm.
Awesome. So final question, so for like a founder raising right now in this market, what is the one thing most of them get wrong and what should they do instead?
I think today a lot of founders are relying on AI, but they're not like to write the intros, but they're not reading the notes. And they often come off as flat and kind of clearly written by AI. And I love the idea of like taking a minute to personalize everything, but that's something that you can, and feel free to use AI for that, but review it yourself, right? Take the extra minute per send and make sure it really sounds like it came from you, and that and that you're addressing someone in the way that you would actually address them. I find myself more and more often on the receiving end of stuff that feels like an attempt to personalize, but that falls very flat and generic because it was so clearly written by a machine.
Gotcha. So Seth, this has been an amazing experience for me to get to ask you all these questions. Where do people learn more about you? I guess you're on LinkedIn, right? Because we're streaming there. But
Streaming on LinkedIn, yeah, I thought that'd be a good place to put this.
awesome.
Well, first of all, thank you for having me. You can find more about me at sethlevine.com. You can find more about Foundry at foundry.vc. You can find more about my books at thenewbuilders.com or thecapitalevolution.com. And we'll find a way to put those in the stream or in the notes as well.
Awesome. And I see we have quite a few people listening live. Thank you all for tuning in. I appreciate it. And yeah, until next time, Seth, maybe hang out for like 1 minute. I'm going to bring the stream to an end.
Awesome. Sonny, thanks for having me.